Welcome back to another episode of the Lone Star Capital podcast with Rob Beardsley, CEO of Lone Star Capital and co-founder. Myself, Craig McGrother, the Director of Business Development. A quick note of housekeeping here. If you're a fund manager, if you're an investor looking to learn more about Lone Star Capital, if you've been listening to this for some time, which I was actually shocked to hear that we had a very elite, very high-end broker listen to a lot of her stuff, but I don't think we've had a chance to actually connect until a couple weeks ago. So you know who you are. I appreciate that. But there are more people out there like that who've been watching us from afar, have been interested in us, but haven't reached out to me. So please do so. Help me help you, but really help me help you. With that said, the email is craig@lscre.com. If you're an investor, capital raiser, fund manager, looking to partner with us, we've got very ambitious goals and soon to be a wildly robust pipeline coming your way if you're a good fit to work with us and we're a good fit to work with you. So we're excited about that. We are going full court press and acquisition mode, of course, next year as well. We've done, or we're rounding into about $200 million of acquisitions here in 2024, which is very exciting. So come one, come all if you're looking to grow and get on the rocket ship.
Very well said.
We'll also be hosting an event in the Bay Area. If you're a said investor or capital fund manager, anything of that nature, looking to learn more about us, meet the team in person in the Bay Area in late December. So email me there as well. You know the email, but once more, it is Craig, CRAIG, at L as in lamp, lscre.com. Now, getting into it. We have a great internal group chat for the Lone Star Capital team. And Rob, you gave us the pleasure of looking at this graph here. So I'm going to share a chart here. Beautiful. So Brad sent us this chart here, and I think this is very indicative of what's going on in the marketplace. So Rob, why don't you unpack this one?
Yeah, fantastic. So this is actually a bit more complex of a chart than what meets the eye, because on the surface, you look at, this is kind of like a cliche chart, right? Everybody knows in the multifamily industry that money was really easy. So developers borrowed a lot in 2021 and 2022 to start a lot of developments. And that's shown here with this very high positive bar in that period of time between 2020 and 2024, according to this chart, right? So everybody knows that money was easy. So developers borrowed to start new projects. Now with development, it takes a couple years to deliver the product, right? It can take anywhere from 18 to even 36 months. So when you start a development, it's going to take, let's say, 2 years to actually deliver the product and lease it up into the market. And so that's why 2024 has been a year where there's been a lot of completions, and 23 as well, because a lot of developments got started back in the easy money times of 2021, and then they got completed in 23 and 24. And that added supply to the market takes time to absorb. And although there's strong demand for multifamily because we have a just secular housing shortage in America, and it's persistent and growing due to population growth and so on, the whole usual bit. Nevertheless, when you flood so much supply at once, it's going to have an impact on rents. It's going to have an impact on concessions and occupancy. And that is encapsulated in that big up bar that you see there. And so these bars represent starts minus completions, right? So how many new developments are getting started versus how many are getting completed. So it's kind of giving you a sense of the development cycle, right? Because in a normal situation, you've got developments always starting, you've got developments from a couple years ago completing, and there's just a steady stream of new supply hitting the market. Now, of course, any market is cyclical. And just like stock market, just like the bond market, just like interest rates, multifamily, there's a cycle. And so with development, there's a cycle as well. And it usually correlates to interest rates, because if it's more economically feasible for developers to build, they will do that, right? Developers are economically incentivized. They want to make a profit. And so they saw profit opportunity. And so they were building all these units. But now you look at this dramatic bar in 2024, and that is pretty much as bad as it gets, because it says 218,500 more units completed than started in 2024. So what does that mean? That means there's a whole lot of projects that have, I mean, quite literally been completed, which by virtue then were started in 2022, let's say, which makes sense, right? That was the peak of easy money. That's when developers were doing it. And now you've got all the completions happening in 2024. So the excesses of 2021 and 2023 are now being felt in 23, 24, 25, as far as development completions and how that will impact supply and demand, and therefore rents and occupancy, to keep it simple. The other thing that this chart tells us is not only are we experiencing a lot of completions, right? That's pretty obvious, but it's also saying there's very few starts in 2024. So this is a bit of a forecasting tool because, and it doesn't take a genius to understand this, if there's very few development starts in 2024, then what does that mean for 2026? Well, it means that there's going to be very few completions in 2026.
Which should hopefully create rent growth.
That's right. We're going to see fairly consistent increase.
Or at least not a free fall in rents and a drop or a stagnant kind of nature to rents.
No, because the demand side of multifamily is very consistent, and it's just plodding along, right? Every year you get more population growth in America. Every year you've got shelter inflation. People get paid more. Cost of living goes up. So the demand side is just very positive. Pretty much every single quarter throughout America's history, there's positive multifamily demand. But of course, demand isn't the only side of the equation. You have supply. And supply is a lot more volatile than demand because, let's face it, you can build units a lot faster than you can create population growth, right? Because there might be a rumor or a study done and you figure out, oh, wow, Katy, Texas has population growth. Okay, well then developers can flood in the next day and start putting shovels in the ground and boom, you got 10,000 units overnight, right? So it's easy to overwhelm even a good demand story with supply. So even though demand is there and it's strong and it's going to continue to chug along, you can overwhelm it with the supply like you're seeing happening right now. But then the flip side potentially will happen in 2026 and 2027, where we actually have a lack of supply and we see the inverse happen, and it will be a very robust time for rent growth. And if you just look at this chart, and we can finish on this note on this chart at least, to see an imbalance of starts versus completions matching today's, you'd have to go all the way back to the early 1970s per this chart. Now, that is on a nominal basis. This chart, if you adjust for population, would be an even more dramatic story because we have a lot more people today than in 1970.
So 1970 was way worse, is what you're telling me?
No. Today is way worse.
Okay.
Because you have way more people and less apartments, right? It's the same dearth of supply, but way more demand today. Hopefully that makes sense.
It does. But so it's better today for investors because that much more supply with less people probably really hindered the market more then than it would now moving forward. That's how I am reading it. Is that correct?
Yeah. I mean, you could imagine that much new supply in the 70s would have crushed demand. Because there was less demand than there is today, right? There's, a lot more population. I don't have the stats, but yeah, we're a much bigger country than 1970.
Yeah, for sure. I mean, probably triple, arguably, maybe even more, right? So really interesting thoughts there. So, and, let's also go maybe 3D here, 2D, whatever you want to call it, go next steps on it. If you're kind of putting your investor hat on, recession hat on, kind of looking at how this all plays out, okay, well, right now, a lot of people say we're in recession. We're basically going through that. If we're not in one, it'll be here soon. But the stock market hasn't dropped yet, right? As we're recording today, it's November 21st. Always like to say that prior to it going live, just so I don't look like a moron. If it, something breaks
treasuries are up today.
Oh, right. And then you'll see 2017, for those who probably recall this, there was a mini recession, and then rates got a little bit cut. So you'll see the imbalance going down there. And then, surprise, surprise, not really. The GFC occurred in 2008, 2009, 2010. Well, look where that is right there. And then going back to, around 1990 or so, I believe there was a little bit of recession. 2001, the dot-com boom occurred. And then, 1980, that kind of goes back. Well, that was is it Ford the president at that point? No, Jimmy Carter, excuse me. I'm crazy. Jimmy Carter was president then. My dad said, nice guy, worst president of all time. He might say that about Biden, but that's neither here nor there. But Jimmy Carter is like very great guy, did not know a thing about economics. And lo and behold, there you go. So all that's to say,
well, if we're going to try to interpret this data a bit more on the fly, like you were doing, with the benefit of hindsight, we can look back at this. We can look at this chart and think back to history. And like you pointed out, the GFC 2008, 9, 10, and then according to this chart, we had a big imbalance, and then the imbalance turned positive, which basically means the developer started building again. That means it was a good market again. People felt good about the demand, and that coincides right here in the chart with 2010-ish, call it, and 11, 12. Those were some of the best years in history to buy real estate, right? Coming out of the supply demand imbalance when the down bar in this chart goes back to positive, that is one of the signs of a very good buying opportunity. And then you go back to the dot-com bubble, it was also a good time to buy, but that bar turned very slightly negative, as you can see, around the 2000s. So it wasn't
as bad of a recession, right?
It wasn't as bad of a recession. And also it most certainly wasn't a housing driven recession, right? It was a tech bubble. But then you look at the early 90s, that was the savings and loan crisis. So you did have actually there's just no development. Nothing was being built at that time. And
there's also an oil shortage too in 72, if I'm not mistaken. They had the gas crisis where if you were an even or odd number license plate, you'd get gas on certain days. Going back there.
Going back to the 70s, that was the lost decade. That was a lot of problems. And I don't really even know the history as far as
stagflation
opportunities for real estate and stuff. But that's a really bumpy ride, as you can see, where a lot was being built in the late 60s, nothing early 70s, then built a lot again. So it's a really bumpy ride. But certainly, if you look at the S&L crisis coming out of it, right, that's when Blackstone actually started buying real estate. That's when they got their start. They never owned real estate before like 91. And so that was a really tremendous buying opportunity for other reasons as well. I mean, there was just less capital in the multifamily industry. It was more of a cottage industry, so to speak, right? It was truly mom and pop. Like you could buy it.
It wasn't institutionalized, is what you're saying.
Right. Now there's a lot more liquidity in the space, which is a good and bad thing, right? There's going to be less opportunity for outsized returns, but there's also going to be much more pricing stability because of the demand from the capital markets side of things. But back in those days, right, you couldn't, the RTC days, they couldn't give away apartments. So Blackstone was buying for 16 caps, fundamentally good real estate. And that was a function of oversupply. And so here we are, we have triple the oversupply right now as opposed to that environment. And we have double the demand. So I guess to put a button on this as well, as we
what does this mean? Let's put a button on it, and then let's also talk about the impacts this is for investors, how it affects Lone Star Capital, how this plays into our strategy.
Yeah. So what I want to say is, although it's been a bumpy ride and it continues to be a bumpy ride, we just had an election. We're in a cutting cycle. The Fed's cutting rates. Everyone's kind of watching and trying to wait and see. Also, a lot of capital has been on the sidelines, and so it's getting pent up and wants to get deployed. The thing is, a lot of people now have looked at this data that we just looked at and are getting bullish and are getting certain about the positive fundamentals that are coming. And the reality is the people that are bidding on deals today and winning them are the people that are looking out a year, 2 years, 3 years, and putting in their pro forma 5%, 6%, 7% rent growth, because that's what they think is going to be manifested from this supply and demand imbalance as illustrated in the chart. So what does that mean? that means for a lot of people that have been sitting on the sidelines and continue to do so in hopes of a market crash, in hopes of being able to buy distress, in hopes of being able to buy at a discount, I think that's going to be a real big challenge, because I think there's so much liquidity in the space. There's a lot of smart capital that's looking at the data, looking at that chart, looking at the fundamentals and saying, you know what, I'm going to place my bet now. And that's going to keep a floor on pricing, right? There's not going to be this free fall on prices and you're going to be able to buy a 16 cap like Blackstone did in 91. Sorry, this is not going to happen.
Well, it just makes me think too, with more dollars being put in this market, the more that makes it more efficient. The more efficient a market is, the less of a, crazy distress opportunity there is. There certainly is distress, but when there's so much capital coming into the marketplace, I want investors to think about this. There's definitely distress out there. Let's not act like there's not. So first and foremost, there really is. But since there's so much capital coming in here, although there's distress, it's not going to free fall where there's no market. When there's no market is when you're kind of screwed. But also let's think about where these institutional capital groups are buying. Well, they're, not really going out on a limb and buying 70s, 60s, and 80s product. They're really buying the newer vintage assets, probably 95 or newer is what they're kind of buying right now. So if you do kind of invest in more of the junkier product, well, there still actually might be a free fall. If you invest in newer product, well, that market's just really efficient. That's where capital's going. So let's kind of dissect that from our strategy perspective. What are we seeing? What are we doing? And what does it mean for our investors? And what does it mean for investors who are kind of investing all across the, age brackets and vintage brackets?
Yeah. So I think it's even more dramatic than that. I forget the statistic that we discussed a while ago about the fact that I think in the past 2 years or something like that,
80% of transactions were done from 2017 vintage assets or newer.
Correct. So basically core deals, right? 2017 vintage. I mean, 2017, it's already getting pretty old now, but still pretty much brand new deals are the vast majority of deals that are trading. So why is that? Well, it's exactly what you pointed out. It's institutional money that is desirous of being active at the moment. Well, they kind of have their pick of the litter and they'll go and pour into the higher quality deals. And so those higher quality deals are being buttressed by that liquidity. And then when you look at the other end of the spectrum and you look at older deals that are approaching obsolescence, those deals have a much different set of circumstances where the bases that those deals were acquired at and financed at means that a lot of them are not worth the loan amount, which means that it's very difficult for an owner to sell for below the loan amount, because then you're going to have to get the lender involved and the lender's either going to have to foreclose it. And, like Brad, our director of acquisitions, was letting us know yesterday about the San Antonio market. He was saying something like there were 19 transactions in San Antonio this year, something like that, which is...
Let's classify this though. So 19 transactions, there's no way that's that few. Of what product type?
Basically of institutional multi.
Let's define that real quick so people have a better grasp.
100 plus units, I'm guessing.
Okay. So 19 transactions with 100 plus units in San Antonio. How many of those were foreclosures?
10.
So that means 9 trades have happened in the San Antonio market. So I just want to speak to this real quick, please, for those investors, those capital partners out here. Just because a deal is, foreclosed or you're basically buying it paper distressed effectively, or the equity's been evaporated, doesn't necessarily make it a good deal. Okay. Does not necessarily mean that this is such a smart thing, this, that. It's so great. You're buying so low. It's like, no, that's just kind of where the market is for that product. That's kind of where equity is flowing. That's not to say you won't have a nice return, but that doesn't make it some automatic grand slam. And I think so many people sucker in investors, sucker in capital partners with kind of some bud wars, some phrasing, some stuff that they saw a couple months ago about distress this, distress that. It is not necessarily making it a good deal. Also, the other thing you have to realize too, on so many of these opportunities, and we'll talk about the situation that we've been dealing with this year, so many of these opportunities too are such a management nightmare and such a difficult opportunity to really turn around that it's going to be all hands on deck to get that over. So there's some investors that like that, but when you're living the day to day of, seeing your occupancy maybe dip down, ticking out tenants, things of that nature, it can kind of wear on you a bit. So just realize that if you're buying distress, don't expect a situation that's not going to be distressed on the management side to get this thing going, as the market's kind of tough, as concessions are going on, as bad debt is kind of accumulating, things of that nature. So just be aware of that. And also don't get oversold on a deal just because it is air quotes, foreclosed or, is trading
You're
below
buying
the
it from the
paper amount.
bank.
That does not necessarily make it a good deal. It's just there was some sucker who bought it too high before in the marketplace that overpaid for it. Okay, well, it's like based on what, right? Based off a bad trade before. Well, it shouldn't have been there before, with debt basically being triple where it is now.
We talk a lot about story, and story is absolutely important. And
story is also how you get hosed.
Yeah, exactly. Don't fall in love with the story and forget the numbers. You should analyze the numbers and let the story confirm your understanding of the deal, right? Because if it's too good to be true, it probably is, right? That's cliche. Everybody knows that. So it's the same thing with the story. It has to match the numbers. You can't say, oh, well, because the seller is taking a loss on this deal, it makes it automatically a good buy for you. Like, just because someone's pain is not necessarily your gain. And that's unfortunately exactly what you're speaking to. The other thing,
I just don't want everyone to fall for it. I don't want people to fall for it. I don't want people to get suckered into something because it's good marketing and good sales on it, and it's like a nice approach. Like, I'm just very cautious for those people who are doing that, because I speak to investors all the time, and so many people are looking for that, and I'm just giving you the tap on the shoulder and saying, hey, do what you want to do, but know that it's not necessarily the best move on the chessboard to make that equity placement.
Yeah, I agree. And that's why we've been very cautious. And like everyone else, we were excited about the idea of buying at a discount, buying distress and all those things. But it didn't mean that we threw caution to the wind and we just bought any deal that had a good story, or that the seller couldn't make their debt payments anymore and they just had to fire sell and stuff like that. Because if it's a fire sale, but it's you and 10 other buyers bidding for that fire sale,
it's not a fire sale anymore.
It's not a fire sale. The price is going to be bid up and it's going to be a market rate transaction. So there's a big, big difference between physical distress and financial distress. And right now, there isn't really any financial distress. Like, if someone needs money, right? Financial distress is, I need capital, right? Well, guess what? There's a lot of capital in the world. It might not be at the price you want, right? It might be at a higher interest rate than you want. It might be at worse terms than you want, right? If you have gap equity, like if you have a bridge loan and it's 40 million and you can only get $35 million of debt and you have a $5 million hole, you can fill that hole. You could make a capital call from your LPs. It might not be pretty, it might not be fun. You can get third-party financing, right? You get rescue pref, you can get all sorts of infusions and stuff. You can do a full recap of the stack. There's capital out there. It's just not at the price that people want. That's not financial distress.
So I also want to explain this to so many investors and capital raisers out there who are maybe not as privy to the institutional world, but so often we get inbounds. I reach out to people, always having these conversations day in and day out. I speak to individuals just as a reminder to those maybe that don't listen to the show all the time or don't really know what my position is. I'm the director of business development. Hi, hello, to those who don't know, but I'm talking to $50,000 check writers all the way up to people who work at Starwood. And think places of that nature, Artemis, Pearlmark, literally you name the name brand. Blackstone, met with someone at Blackstone at Ascent Miami. Okay. I'm not that cool. It's just, that's the business. Right. And so often, people say, oh yeah, well, we're doing this, we're doing that. And they have their common equity bucket, which is basically if a unicorn walks through the door, they will give you a joint venture check on it. Right. And as we know, unicorns rarely exist. They have a pref fund, which, they're looking for someone between probably a 14 to an 18% coupon in your deal, where they're basically on their tranche going to soak up X% of that. And that might leave you with nothing as a sponsor other than some of the fees you get along the way, which for some people, that's their business model. And that's okay. Not everyone has got to keep the lights on at the World Trade Center, but there's also other buckets currently, right? Which is recapitalization. Okay. Hope notes, collateralizing your entire portfolio to give you capital and some of your deals. That is what is going on right now in the marketplace. And when there's all these things that are actually creative financial solutions, and we're not talking about Pace Morby here, but creative financial solutions and opportunities here, that kind of diffuses a lot of the distress going on. So I just want to make that very clear here that there's so many options out there in the marketplace before it would even get to a foreclosure situation that if a deal actually gets foreclosed right now, that deal is so effed, you have no idea. And you got to get that deal probably handsomely below paper to even make it make sense. And then if you acquired the deal like that, and then if it made sense, now you got to go through a 2-year journey, 3-year journey to get this deal to actually performing well with good tenants there that are going to pay, after everything else is going on. Because sometimes when the Titanic is sinking, people stop paying rents because they know they can get away with it. And then you got to evict people. And
There's
then you got to do
lot
this.
worse. Sorry to interrupt you. There's a lot worse that happens than just people stopping paying rent. When someone becomes financially distressed, or when an owner realizes, like you said, the ship is sinking and they're going to give the deal back to the bank, or they're going to fire sell it for a loss. So imagine a seller is going to sell a deal for a loss, right? And they know it. They're just trying to survive, and they're going to dump the deal onto the market, and they're willing to walk away and take a loss. Well, do you think they're keeping that deal in good shape? Do you think they're investing in the long-term success of that deal?
Or you think those leasing agents give a rat's what? No, they don't care. They don't care. It's over. They're going to do leasing at a different property. It's done. The ship has sailed. They don't give a rat's what. They don't care. It's done.
The owner will allow deferred maintenance to accumulate, right? If it's coming, if there's a roof leak, are they going to spend all this capital to replace the roof? Of course not.
No.
I mean, not saying they should either. I'm just painting a picture. They're going to do the cheapest patch job possible. And the same goes for all the other repairs happening at the property. So they're going to cut all the contract services. They're going to let weeds grow. They're not going to call the landscapers to come out every 2 weeks and pay them $3,000. No, they're going to save on the landscaping.
And you think their T12 and their pro forma is really credible and legitimate? You think so? You think that the numbers they tell you, yeah, I'm going to take this at face value. Like that ship ain't sinking? Like, come on here. Like, guys, like these, and I know we're being a little animated, more me here on this situation, but time and time and time again, I hear so many people get absolutely famoosed and suckered into these distressed deals. But what are you comparing it to? Like, you can lose money here. You can, in fact, lose money even buying a deal that's foreclosed. You can, in fact, make a bad investment. And also, what are you benchmarking it off of too?
It's tough. It's a tough game, tough business. It's not to say that you can't buy one of these deals and be successful. It just has to be priced accordingly. You have to be capable, and ideally you don't run into, there's always going to be surprises, but ideally you don't run into so many surprises where it flips your math upside down.
Do you know why people market and tell stories?
No.
Because it works. Marketing is done because it works, and don't get trapped into that. Okay. So of course we might have a situation that hits some of these buckets, but it's going through and comparing and contrasting to what other opportunities are out there in the marketplace. It's not just a one size fits all, not a square peg in a round hole situation. We're going to be very smart with any acquisition we do, which is why it's important to the investors. And bringing this back to this investors, I just want to educate you. I just want to let you know that you can in fact get suckered. And there's a story within the story here, and don't get baited into something because it's kind of the soup of the du jour, the flavor of the week, the opportunity of the week, the special of the day. Okay. So as this impacts to investors, this chart, just to bring it home there, to put a bow on that once more, when there's a lot of supply coming on, stops happening, there's stuff that needs to get worked out. Rents might stay flat. We're kind of seeing that all across the board, although Houston having a little bit of a bump, just a little. But we're seeing rents kind of stay flat, and a lot of situations drop. Phoenix is dropping. Austin is dropping. Dallas, some pockets it's down, some pockets it's up. San Antonio going down right now. Okay, so what does this mean? It means that, yes, this might be here for some time. It might absorb for a bit, but 2025, back end of it, everything should be delivered. We should be good to go. We'll probably get another graph in a year like this, Rob, where it's probably going down. Not exaggerated as much would be my guess, but we're going to have another chart from the chart we saw. Might be going down a bit more because I don't know how many people are starting.
Will have. It's a good question. I think 25 will be, I think that chart will be somewhere.
I think it'll be playing down as my prediction.
Maybe a little bit down.
I think it's going down, but what do I know? I'm just a UVA degree. I just went to the Harvard of the Southwest, University of Arizona. What would I know, right? But at any rate,
that's really fascinating.
This is for investors. Think about, we might have another year of that, which means 2026, 2027, and 2028 will be really good years for multifamily growth. And when you're a value add investor, not a developing investor, rent growth and those dynamics and cap rate compression will start to happen once supply is limited and once rent go up. So can you kind of just speak to that and kind of what the tailwinds, because we're obviously experiencing the headwinds for what we're doing, but what's the tailwinds become in a couple of years?
Yeah, so come 26, 27, the tailwinds are just the inverse of the supply demand, where the demand is still there because housing is a necessity and the population will continue to grow, but there'll be a dearth of supply. There'll be, because there's not a lot of development activity happening 23, 24, 25, then in those years, 2 years later, when those units weren't being built, therefore they're not being delivered, that's going to provide a lot of pricing power for all the existing stock. It's going to increase rents across properties. It's going to cause occupancies to go up. And that's going to be just very positive for pricing, because obviously the higher your rents are, the higher NOI, and then property is valued based on the income of the property. And then not only that, once people start seeing this rent growth, even before they really start seeing it, they'll kind of start forecasting it, and it'll be clear. Cap rate, that'll push cap rates down, right? Because a property's value isn't just its income today, it's projected income out into the future, discounted to present value. So if buyers in the market recognize and have a consensus that rents will be strong, rent growth, that is, will be strong, 26, 27, 28, perhaps, that's going to impact the cap rate that properties are valued at, which is going to bring cap rates down. So what does that mean? I think it's really interesting, because I feel like today we're at a crossroads. We're at a fork in the road right now, because over the last 2 months now, interest rates have gone up a lot. And they've gone up a lot. Nobody ever really knows why, but they've gone up a lot, people believe, because the market started forecasting a Trump victory, and Trump, they believe to be more pro-growth for the economy, more inflationary. And so that would cause, what it's caused is it's caused people to sell bonds, which pushes the yields up. And they've put that capital, as you can see, into Bitcoin, which is crazy, and stocks. And so those things have traded up. So, but real estate's a slow moving animal. So it's not like we have instantly seen real estate prices go up also. And also, real estate is one of the most interest rate sensitive asset classes. So it's kind of bad, because although people are getting more optimistic about the future, which should push real estate prices up, we're also staring at higher interest rates today. So the 10-year has traded up. I'm looking, basically 4.4%. And that's a far cry from being close to touching 3.5%, but completely different universes. And so this fork in the road is basically, okay, interest rates have gone up. In order for buyers in the market to be able to transact and basically acquire property with fixed rate financing, they're going to need to be somewhere around neutral leverage. Well, if we're at a 4.4 interest rate, and let's say the average spread is about 1.6% for a 5-7 year fixed rate loan, that means interest rates today are around 6% or so. That means you need to be buying at a cap rate of around in the high 5s to 6. And I'm not even asking for positive leverage. I'm just asking to be minimally negatively levered, right? Which is realistic. That's the name of the game. Unfortunately, there's just not beautiful institutional deals in growth markets like Dallas walking around.
Why?
That you can buy for positive leverage. It's just right. The game's not that easy, right?
No, so it's not Blackstone buying 16 caps in growth markets.
Yeah, no, it's not 1991. So with all that being said, where do we go from here? Are cap rates going to go higher to accommodate where rates are today? Because it certainly doesn't seem like it. It seems like people are getting more optimistic about the growth, and therefore that pushes cap rates down. Well, then how do people buy deals, right? Is it people are just going to wait around, and does that mean that interest rates are going to come down, and then that's how we're going to have a normal functioning market where interest rates come down to 3.5% and you're able to borrow for around low 5s and you're buying in around a 5 cap? Or yeah, so I mean, and then finally, just to throw a kind of a third thing into the mix is floating rates, right? Where are those today? Where are those going? And is that a way for some people to buy today, right? And basically, they're not locking in the fixed rate. They're going with the floating rate and saying, okay, I can stomach where floating rates are today. They've already come down from their peak, and the Fed's going to continue to cut, they believe. So they can stomach where rates are today, and then they'll see them float down over their hold period of the next 2-3 years. But the important point was they were able to have the guts to buy today before the rent growth comes back and before cap rates compress because of the optimism and the liquidity in the market. So that's one reality. The other reality is, Jeremy Roll's reality, which is recession, cap rates go to 7%, rates stay higher for longer.
Jeremy's humble because Jeremy Roll, shout out to our friend Jeremy, he said, hey, you're probably going to beat me most times, but I'm just not willing to lose money. And I love that mindset. Like, that's he's like, hey, he's very humble. He's very open about it. He's like, this might be an unrealistic benchmark. And once everything gets kind of worked out right now, I'll probably have to recalibrate it, because he's kind of going off of what last recession's run was like, what it was like beforehand. So he is in real time, like everyone else, kind of recalculating, and he will do so in a year or 2 years' time, because he does want multifamily exposure. So interesting thought to think about there. And, just to go over kind of the stock market, real estate, what we know about those two things, obviously, everything is interest rate sensitive, particularly us, but the stock market can change like this. It can change overnight, right? It can move instantaneously. Real estate's a very slow trading asset. It's very slow, which is, a big benefit, obviously, right? So it's just something to think about. It does not change overnight. Cap rates do not change overnight. And what we've actually experienced, our director of acquisitions, Bradley Oliver, friend to the shows, of course, went through kind of some analysis and just kind of what he was seeing, which is that, quite frankly, cap rates are staying compressed and actually have gone down despite treasuries running up about 80 basis points recently. And what's happened and why is that the case? How could that be? Well, there's a lot of buyers and a lot of money going on right now, but sellers aren't capitulating to where, a lot of the pricing needs to be in order for deals to trade. So what are they doing? They're simply pulling their deals off the market, creating very low transaction volume, compressing the cap rates, because capital is going to flow where the deals are for the benefits associated,
scarcity
right?
Premium.
Exactly. There's a scarcity premium in there, which is keeping, cap rates compressed, which is a very big challenge for most people, because, that means your leverage points, if you're buying on a lot of negative leverage is going to have to be, a lot less than what people are trained to. I also think at a macro level too, moving forward, deals aren't going to be flipped and hot potatoed in 2-3 years. So I think investors are going to have to get retrained here soon. If you're one of our investors, if you're just going to be multifamily real estate, or just a real estate investor, generally speaking, with so much money flocking to this asset class, you're going to have to get retrained on what a normal and standard and good IRR looks like. The days of, call it the 16 to 19, I don't think a realistic project if so much capital is in the marketplace. I think you're going to have to be recalibrating more to a 12 to a 15, to have a good, safe deal. Obviously, if you want to risk your profile, if you want to go, on a crazy bridge with some distress situation, right? To call back there, yeah, maybe you can kind of solve for that higher teen opportunity. But I think by and large, get comfortable and get used to the fact that better quality deals, that ones that worry me probably buying moving forward, are likely going to be at a more compressed, IRR, internal rate of return, than what has historically been the case.
Yeah, I agree.
Yeah. Okay. So final topic here, because that went probably longer than you and I both expected. You are creating something really unique right now, which is Lone Star University. So do you want to explain what that is? And this is also, frankly, news to me. So I don't know anything about this. So I'm excited for you to educate me as well on this new concept.
Yeah, well, we've been investing a ton in operations this year. My new role as CEO, I've been really focusing on operations, with Ina's role as COO, and Hannah is now our director of HR. And we're actually hiring we've hired a couple new people as well, from an accounting firm. So with a lot of HR experience, a lot of banking, controller, accounting experience. And with all that being said, this is kind of like a new mini brain trust, where we are in the process of rolling out something we're calling Lone Star University, which is basically a unified, streamlined training or collection of training programs,
courses.
courses, modules for everything happening at the company. So when someone joins the firm as a leasing agent, right, there's going to be leasing agent courses, and you get your silver certification or whatever it is at Lone Star University. And, it's basically just a collection of written material, video materials. I actually recorded the first screen recording video of me explaining our general ledger, which is an accounting thing. So that's really exciting to be able to. It's exciting because it's work you do once-ish, but then it just provides so much reward and
really
it saves
scalable,
you so much time.
Time saving, but also this puts systems and standards in place, which now you don't have to sound like a broken record, and they can ask you questions. You can make iterations off of it in the future, but you're really wise to do this. And no, not you. Don't ask for it. You're not getting it because you're not a Lone Star leasing or part of Lone Star Communities. So I just want to preface that.
Yeah, and I thought about it too. It'd be interesting. How do we maximize the value of this? Like, do we maybe share some of it to the public and kind of, or we obviously want to get our money's worth and maximize it. And at a minimum, we want to share what it is and let our investors know that this is what we're working on. Not totally off topic, but as a connecting topic, I was listening to some Hormozi videos, Layla Hormozi, as a matter of fact. We'll be attending their workshop in January in Vegas, so that's exciting. Sorry?
Just you?
Yeah.
Are you bringing me too? That's so nice of you.
No, it's just me. I'll be getting the picture with Alex.
Thank you so much for enriching me and bringing me along.
You already have a picture with Alex Hormozi, so.
True.
So in that video, Layla was talking about your customers see what you show them. And this is an old Tai Lopez thing. Years ago, I remember Tai Lopez saying, marketing is very simple. People see what you show them. And when it comes to our investors, they see what we show them. So if we were the average sponsor and we just sent out quarterly communications and it was just like, hey, here's your distribution, here's the occupancy of the property, here's some financials if you want, and that's it. Okay, fine. Maybe that sponsor is knocking it out of the park operationally, but the investors don't really know. But if we're doing our best to actually show our investors what we want to show them, we want them to see what we want them to see. And so what is that? We want them to see that we're working hard on innovation, such as Lone Star University, such as this super cool, top secret beep program that I can't share, but really would have loved to share. But we're working on something very exciting. It's a holiday program for the teams and all the properties. That's super exciting. So we have to share all the things that we want our investors to know. We can't just assume that our investors know everything that's going on at Lone Star and just that they automatically know that we're doing a good job, right? We actually have to be good communicators and sharing our monthly updates, sharing what's happening, sharing the challenges, sharing how we're overcoming them, sharing the wins. So
well, it can feel granular to us and very small, but quite frankly, when I was a realtor, not that anyone needs more of those stories, but when I was a realtor, my mentor was like, sometimes you do have to brag about yourself and toot your own horn and say what you did and posture things correctly for the win that you just created. And you have to let them know, and you have to brag about yourself a bit. So for those who are wondering, yes, of course we have tricks up our sleeve. We got so many plays, we have so many moves, but we don't share them all the time. So I'm happy you're kind of giving a little secret sauce here.
Yeah, that's right. So yeah, just a little announcement there, but we'll find more time to share some more updates.
So let's just, this is all about the investors, all about the fund managers and things of that nature. What does Lone Star University mean for them? How does that ensure more confidence? How does that create a better environment to invest with us and work with us and have more trust and certainty? Just like the trust factor, how does this really, how should this make them feel better and more comfortable with us?
Yeah, I think that's a fantastic question. And I think what's really interesting is a question that we've been getting a lot lately from investors and fund managers is, how have you handled your growth? Because what a lot of people have realized is they invested with sponsors that went from 0 units to 1,000 units to 5,000 units, maybe even 10,000 units. in the last 5 years or so. And now it was fun writing that up and buying all these deals and go, go, go. But now they have to live with those decisions. They have to live with those properties every day. And it's difficult. Everything is difficult, right? Building up the scale to be able to raise that kind of money, that's very difficult. Building up the skills and capabilities to acquire all those properties, that's very difficult. But the most difficult and the least scalable, the one that takes the longest to build up, is the operational capability. So, okay, it's one thing to go out on a buying spree and buy 20,000 units, but what about the foundational infrastructure to actually be able to operate those 5,000, 10,000, 20,000 units, right? So that's a different story. So we've been getting a lot of questions like, okay, you guys are doing great. It looks great. You guys have been growing a lot.
We like you guys.
How are you handling the growth? And if we're telling people, we tell our investors, we tell everyone, yeah, the goal next year is to acquire 250 million in property. That's, give or take somewhere around 2,000 units. And we have 5,000 units today. So that's 40% of our portfolio that we plan to add next year. That's rapid growth. So people want to know, how are we planning to be able to handle that growth? And so Lone Star University is one of the answers to this very big question, right? And then, like I mentioned, we hired those 2 ladies that are from this accounting firm, and they're going to serve and grow with the company on the HR side, on the accounting side, on the banking side. And so there's a lot of infrastructure being invested in that isn't sexy. It's not front and center. Like, we didn't go out and add 3 more Craigs onto the team. Well, not that you could ever be duplicated, but it's not like we've got a bunch more Dashas, Craigs, and Brads, and people that kind of are seen by the world, right? It's kind of the back end stuff, the less sexy stuff. So it's all those investments, and it comes down to, again, we need to show investors those investments that we're making into building out all that infrastructure that I mentioned operationally, finance wise, banking wise, HR wise. HR is a whole beast in itself, and Lone Star University is there to help manage that growth as we add new people. We want to make sure that they have our culture, that they have our SOPs, our standard operating procedures. So that, I think, is my answer to that question.
Excellent. So moving forward, for those here listening, know that just because it's distressed, just because it's a cool story, doesn't make it a cool and great investment. So realize that story is obviously important, narrative is important, but don't get oversold by the narrative. And then for those working with us, we were only getting better and more precise and more dialed on the management processes, leasing processes, systems in place. We've got a great program coming in place here also for the holiday season coming up, as it is, typically speaking, a slower time for leasing, but we're going to really supercharge what's going on there. So that's very exciting. Also, I want you to comment if you're listening on YouTube, or send me an email if you're a listener. And I apologize if you are a audio listener, that graph might not made any sense. So probably should have prefaced that. But with that being said, excuse me, what are your thoughts? Do you think the story matters that much? Do you blindly go through story, and have you seen people market?
Are you conditioned to invest with the sponsor?
Have you been oversold in a story investing wise, or have you seen sponsors really harp on stuff that might be, sound nice, but actually in reality isn't that special? So I want you to comment and actually give us feedback there. And if you want to ask any questions that we want to cover on the show, send me an email, drop a comment, we'll address it. So we're very accessible, not too accessible, but just accessible enough. So with that said, thank you so much for listening to the show. We'll see you next week. Any final words, Rob? Excellent. Thank you so much for being here. Drop a comment, like, subscribe, the whole 9. Peace.